All right, so let's understand the trajectory of fixed income. Fixed income has been a space that's been buzzing a lot, but due to the right asset allocation or maybe the strategy as far as diversification is concerned, investors are attracted to this category also due to rising interest rates. But what's in store further? Looking at the inflation concerns and slow monsoon, what's going to be the interest rate trajectory? Let's discuss all of this and dissect this with Rajeev Radhakrishnan, CIO Fixed Income SBI Mutual Fund. Rajeev, good evening and welcome to the Money Show. So a lot of data coming in where investors are looking very keen in investing in fixed deposit, and we've also seen the interest rate trajectory so far where debt right now looks very attractive for all those investors who want to maybe rebalance their portfolio or maybe want to have a debt exposure. But going ahead, what's the story that you see brewing? Because in India, if we talk about domestic triggers and also the bond yields, which have now which are moving in a very range bound territory also because there's no much queue for them. But then having said that, inflation still remains a concern. Slow monsoon, which is also predicted to be a dampener. August we've already seen a slowdown, and this September also we might not see any rains as predicted. El Nino is already active. So looking at all of these triggers and the kind of situation that's emerging, what's likely on the interest rate front as per your reading?
Yeah, thank you. Good evening. So very clear. So some of the factors you did mention in terms of potential risk factors from a fixed income market perspective, given that we still have inflation which is fairly elevated, which is above the upper end of the policy target. So that probably would be the near-term worry from a market perspective, because from a policy perspective, what we have seen is over the last year or so, policy rates have actually gone from 4 to 6.5, but the effective tightening that the central bank has done is more than that, given that we've moved liquidity from extremely surplus to almost neutral today. So we've seen a significant amount of tightening which has already happened in India. But the near-term challenge continues to remain that headline CPI, which is the nominal anchor for monetary policy purposes, is way beyond RBI's range of comfort. So that will continue to engage the attention of the central bank in the near future. And we have seen the early signs in terms of the RBI's intent to absorb liquidity from the market. In the last policy, we did find the RBI going ahead with a liquidity absorption measure. So my sense is that probably would be the near-term dynamic that the central bank would try to maintain in terms of ensuring that the excess liquidity in the system is absorbed. But over a period of time, there is a non-trivial risk, I would say, that at some point, would the policy rate, would it need to be adjusted even higher? So that is one risk the market will have to look at over the next few months. But the bigger comfort from a fixed income perspective today is, as I mentioned earlier, a significant amount of tightening has already been done. And secondly, even when you look on a 1 year ahead estimate basis on inflation, even if you assume the expected average inflation to be about 5.5, fixed income yields today, which are trading anywhere between 7 to 8%, depending on the tenor. So 1 year T-bill today is trading north of 7. So you still have real returns which are available in fixed income instruments in India today. And I think that, apart from the diversification angle that you did mention initially, would be the key investment points from Indian fixed income angle. And the other dynamic, of course, is how global interest rates evolve as we go forward. But the key message that we get from when you look at overseas rates is the markets have broadly got, I would say, adjusted to the reality that policy interest rates may stay higher for a bit longer. And I think that's what is probably getting reflected in global bond yields, especially the 10-year treasury yields in US, which has marked up or rather gone up significantly over the last 3 to 4 months.
All right, so Rajeev, talking about the bond yields itself, do you think the 10-year bond yield in India have already peaked out, and the kind of triggers or potential triggers that we just discussed won't be a part of further movement of the bond yields going ahead?
So we have to accept that over the last few months, our bond yields have been relatively stable in spite of a material upward, I would say, number in terms of inflation, way beyond what the market was expecting, and probably a little bit higher than where the RBI was also projecting. So in spite of that, our bond yields have been fairly stable. Of course, it's moved up around 20 odd basis points over the last couple of months. That's something I think that there's a lot of, I would say, from a market perspective, what is encouraging is the demand is fairly robust, more so from the longer term investors. So with a fiscal dynamic which is broadly on track in terms of fiscal consolidation, we don't really see the risk of additional bond supply at this point, and demand remaining fairly okay so far. These are some of the technical factors that one needs to be mindful of. So even as we face a lot of headwinds with respect to bringing or aligning inflation closer to the policy target, eventually the market reaction would be a function of how the bond demand supply dynamics seem to hold up. And I think that is something encouraging so far. And as we get into the second half, the net bond supply would be materially lower than what the market had to absorb in the first half. So and then again, you will have the routine noise which happens every half year with respect to possibility of bond index inclusion and all those news items. So from the demand side, it remains fairly okay at this point. What is really, I would say, worrying is the macro perspective only on the inflation side. So I think end of the day, where bond yields end up over the next few months would be a function of how the macro dynamics and the market technicals in terms of demand supply sort of match up. So overall, I would say that we're really unlikely to see a big up move in yields. Maybe a marginal drift upwards is what I would take a estimate at this point in time. So that's where we stand. So even though there are some headwinds with respect to inflation, the demand side dynamics seem to be holding up fairly robust. And that, in a way, probably should insulate the bond market from any material up move in longer-term bond yields.
Sure. Now, apart from that, talking about US inflation, do you think there's going to be a twist in the story? Obviously, a lot of it depends on the data, okay?
Correct.
But so far, how's it looking to you?
So in terms of US, how the whole macro dynamics have shifted over the last few months. So if you recollect, in March, the financial markets were fearing a crash landing, right? You had a lot of regional banks failing, and at that point in time, the market was looking at a financial stability driven issue, and the Fed or the central bank would probably be forced to come in and cut interest rates. But we have seen that that particular segment has largely stabilized because there was a very forceful intervention by the Fed. Today, what we are seeing is inflation has actually started to go down, even though it is higher than their policy target. There is a deceleration trend in inflation, but core inflation is still above their comfort zone. At the same time, whether it's on the other economic growth indicators, the labor market is still holding up fairly robustly. So we've moved away from fearing about a crash landing to something called a soft landing today, where inflation gradually moves closer to the target and growth numbers remain fairly robust. So that's something from a bond market perspective, it is sort of getting reflected in where the market yields have gone up. And at the same time, today the market has pushed back its estimate of when the first rate cuts would start to come in. So the whole dynamic surrounding a soft landing probably would not warrant significant monetary policy easing by the Fed. And I think the story of higher for a bit longer sustains. And with respect to inflation, this is something that was reiterated even, I think, in the recent Jackson Hole conference, where the Fed is very clearly committed to bringing inflation to its policy target of 2%. So the easier job probably was to bring inflation down from 9% to probably 3 or 4% today. But getting down from 4 to close to 2 on a sustainable basis, given that the labor market and other macro indicators are holding up fairly well, I think that could be a challenge. And I think a lot will depend upon how the transmission of earlier actions continue into the real sector. And I think hopefully you will have a situation where inflation gradually aligns towards the target without them having to do further policy tightening. And I think that's our base case, that we don't think they would tighten further, but would they cut in a hurry? The answer is probably unlikely.
So right now, what should be an investor's strategy? What kind of a fixed income duration should they lock their money in? Because I remember having the discussion earlier with a lot of experts. If you just take the first half of this calendar year, where we were expecting by this time, or maybe in few months, we would see a rate cut or maybe an extended pause, the scenario has completely changed. Okay, so now at that time they were recommending maybe a medium to a long-term strategy to investors. But looking at the current scenario, you think a shorter duration makes much more sense?
Yeah, when you look at an aggregate, so I would, always say that it's end of the day, it's individual investors' risk tolerance that should determine which segment or what duration risk that you should take. But an aggregate, yes, the outlook towards taking large duration has very clearly shifted. So as you rightly mentioned, 4 months back when we were looking at a policy pause and a potential, maybe a shallow rate easing cycle down the line, today, that equation does not really hold. Given the high inflation that we are still facing, it's very unlikely that you will see a situation where the central bank in India would be able to cut rates anytime soon. But at the same time, the broader favor, or rather the broad preference towards the shorter end of the curve still sustains. And the reasons are very clear, because you have absolute yields which are fairly attractive. I did mention the prospect of real returns. So, for example, today you have a 3-year high-grade bond that trades anywhere between 7.75 to close to 8%, depending on the issuer. And even if you assume that on a forward-looking basis, inflation would stay not at 4, say even at 5, you still have visibility of real returns. And I think that probably is the most compelling argument today. The second, again, at some point down the line, say over maybe an 18 months to 2-year timeline, you could potentially see the interest rate cycle shifting. So these are near-term headwinds that we face in respect of an immediate challenge to bring inflation closer to the policy target. But given the fact that a significant amount of tightening has already happened, given the policy hikes and the absorption of liquidity, and you should see the lag effect of that working its way through the system over a period of time. So if one has a tenor of, say, 18 months to 2 year or even beyond, depending on that time preference, you could potentially be looking at even scaling up into slightly longer duration products. So end of the day, it's largely going to be a function of what timeline and what investor risk preference is there with respect to duration.
But because a lot of investors are interested in knowing about fixed deposit rates, so for now we can say that these rates can go up for a couple of months.
FD rates, if you're asking, I'm not really sure, because we've not really. So we did see a significant amount of, I would say, a catch up or adjustment in FD rates towards the second half of last fiscal year. But is it happening now? I'm not really sure, because I think it's broadly reached a situation where rates are stable. Of course, CD issuances have started, given that the RBI has impounded liquidity on a temporary basis. But overall, I think FD rates should remain stable from where it is right now. I don't really anticipate too much of increase there. So on a like-to-like comparison, given this possibility of the rate cycle moving or shifting lower over a slightly longer term horizon, any of the fixed income funds would really be a good investment proposition. But again, it's again subject to the fact that investors are okay with that timeline and with that particular duration risk.
Thank you so much, Rajeev, for being on the show and helping our viewers with their fixed income strategy today. Thank you.
Thank you. Thanks.
All right, time to slip into a quick break, but then post that, let's talk about securing the future of your specially abled child. We'll be talking about investments as well as insurance aspect of this situation. We'll be joined by Shilpa Gole for this discussion. But then before I go on a break, I'm going to leave you with our WhatsApp number and email ID, where we keep waiting for your questions. So anything related to your financial portfolio, be it mutual fund, insurance, credit card, tax, or anything related to your financial goal as well. If you're stuck, do send us your question on our WhatsApp number, email ID, and we shall get it answered by our expert on the show live.